Okay, folks, welcome back. All right, so tonight we're going to be talking about a price action model and an example of fleshing one out. And I'm going to give you the raw information, okay, in other words, the outline, if you will. And then your job is to fill this in as you go through the mentorship. Okay, now normally everyone has to go through the core content, and then I give 12 different price action models. And I kind of like outline them and flesh them out for you and show you what they look like. This one, I'm only going to give you one example because this is exactly what I used today in concert with what we did in the weekly review on Saturday, the week prior to this week's opening. I did the analysis and shared it with you guys on Saturday on the 11th, of May 2019. And if you haven't watched that video, okay, it's important that you go back and watch that one first and then watch this one, okay? Because I know I made special attention to this on Twitter, this particular teaching tonight. Plus, it's a Monday installment, so usually you don't get an episode from me on a Monday. But the truth be told, the reason why I'm doing the Monday teaching is I may get a very, very, very light Wednesday. I may not be able to do a Wednesday video, kind of like a cover my rear end type episode. So that way you get something this week instead of a Wednesday upload that maybe in a form of a chart or some text commentary. So one way or the other, Wednesday you'll get something. I just don't know for certain because of my schedule if I'm going to be able to record something on Wednesday. Okay, so just take that for what it is. All right, so again, this is a price action model example, and I'm going to show you what I did today, but some of the things may not be clear to you if you're new. Okay, if you just started, some of these things may be a little unclear to you as to what they are, what they represent, what they look like, all those types of things. So I'm going to kind of quickly go through what I did today, but I promise you if you go through the entire 12 months core content, you're going to know what I mentioned here, and you'll know where to place them, okay, based on the outline I'm going to provide for you. So I give you guys a lot of details in the chart and draw things up for you. I'm not going to do that. It's all going to be your note-taking, okay? So again, it's for more or less the newer students, okay, like month 1, month 2, month 3, those folks that are going to benefit most from this one. Obviously, the charter members that have gone through everything will know right away how to plug and play everything I'm telling you here, and you'll see that it's a pretty good one. Okay, so it's a real basic one. Hasn't incorporated a whole lot of new acrobatics or anything like that, but some of the things that you've recently learned in the last 4 to 6 weeks from me, we're going to incorporate that. So just know that that was a catalyst that led to this one. Okay, so for the charter members from 2017 group, no, this is not model number 12. I could have done that. I really could have done that, but nonetheless, this is something entirely different. So it's like a project for you all. While you go through the mentorship, you want to come back to this teaching and what you flesh out from your notes and build this actual model, from your better understanding, not just simply, okay, I understand what he said and there it is, and I want to know the next one, okay, because you all know there's 12 different models coming. You don't need all 12. You just need one that make you understand what price action is doing and trade within that condition, okay, which leads me to the first central tenet to any price model is what's the condition in the marketplace, okay? So what that does internally asks of me in terms of analysis, am I bullish or am I bearish, okay, and what leads to those decisions. So right away, I want to talk about how we mentioned in Saturday's review for the week to come, which is what we're trading in now, May 13th, 2019. We have this order block here. I mentioned this. And we have this swing low here. I mentioned that we would probably sweep below that. Price came down and traded into consequent encroachment. When price trades into a higher time frame daily liquidity pool, and that's what this is. Now, it's a liquidity pool because it's below this low. That's all I'm going to say. There's other factors that leads to the definition of it being a liquidity pool, in addition to that swing low. Everyone pretty much, even from free tutorials, understands that that would be a sell stop liquidity pool. Okay, it would be a pool of liquidity in the form of sell stops resting below that swing low. It's reasonable to expect price to want to drift down into that level and absorb or purge that liquidity. We see that has taken place today. Okay, what I'm going to draw your attention to is when I say, and this is the only thing I'm going to build on a little bit in terms of explanation, because I already know I'm going to get 12,000 emails. What did you mean when you said this? Okay, so I'm going to amplify just this portion, and everything else is going to be pretty much gunshot towards you, and you'll have to write down the notes from what you hear me say. Okay, and right away I already hear some of you hissing and, this isn't what you said. This is exactly what I said. I'm gonna outline everything. You're going to build this as you go through the entire mentorship. Okay, so the components of when do setups form and higher probability setups, when do they form, is when there are opposing liquidity pools being tapped at the same time. And what do I mean by that? In this particular market here, we're looking at the dollar index. So if we're going to be trading foreign exchange, as I teach it, we use the dollar index as a barometer. Okay, so if we're bullish dollar, we're going to be bearish foreign currency, euro dollar, British pound, the Aussie dollar. All those pairs should bend the knee. Notice that Game of Thrones little pun there. The lower movement in foreign currency should be seen with higher prices in the dollar index. Not always. As I mentioned in recent weeks, that the dollar index can stay consolidated and foreign currencies can still be allowed to expand higher or lower. Think in terms of like the euro pound. The euro dollar can be held in consolidation while the cable is allowed to rally, and that would cause euro pound to drop. So that same premise, or what causes the market to stay within a consolidation of one pair and expand in the other, that can occur in the dollar index. Okay, so the way we avoid getting tripped up by that scenario, because I even mentioned that would be probably a scenario that we would see here with the dollar index relative to its daily chart, that it's dollar being held in consolidation and allowing foreign currencies to trade and expand. You want to wait for the dollar index to trade into a liquidity pool, okay? And once that liquidity pool has been traded to, orders are going to be entering the marketplace for the dollar index. In this case, sell stops would be running hot. That means there'd be a flood of sell side liquidity. So anyone that would be looking to go long would have a great deal of liquidity to go long against as counterparty. Okay. At the same time this occurs, okay, you want to see your foreign currencies trade into liquidity pools. If there is a trade forming and only the dollar index is trading into a liquidity pool and euro dollar or cable has not traded into its respective liquidity pool, the pattern or setup in the context of high probability is not yet there. But when they both, or preferably all three, that being the euro, cable, and dollar index, all at the same time respectively trade into their liquidity pools, that's when high probability exists. Okay? So that's the only thing I'm going to really amplify here. Trust me, you'll learn more about this as you go into mentorship. If it doesn't seem clear to you, don't email me, because I'm not going to answer your question. I'm just going to say it's going to be answered in future lessons. This teaching tonight is to give you a 12-month long homework assignment. Okay? So the premise, once we determine a condition, okay, are we bullish or bearish, the premise that leads to that bullish or bearish scenario is going to be a large point of internal dialogue for you. Okay, what leads to your bullish or bearishness? Well, if we're going down below this low here and purging that sell side liquidity, that means there could be a potential to see the dollar rally because it's tapping into a pool of liquidity for sell side liquidity. Whenever the market trades into a pool of liquidity for sell side, okay, or running sell stops, it can be forming a opportunity for the dollar to be accumulated on the long side. So if that is the case, as we see here, that may lead to a bearish scenario in euro dollar or cable. So if we know that this is when, not timing, okay, there's going to be a distinction here. When do setups form? When liquidity is purged or engineered, and you'll learn about that in the mentorship. The timing of the trade is something entirely different, okay, because all this is saying is the conditions are now ripe for a setup. But this is a daily chart. We still have to incorporate time of day. Okay. Now, you don't have to incorporate time of day if you're going to be a position trader. And I'll mention this in closing for scaling purposes. So you can set this up for any type of trading model. You could be a long-term position trader. You can be a swing trader, short-term trader, day trader, scalper. It doesn't make a difference. One shot, one kill. All of the things I'm teaching you here tonight are applicable and scalable relative to that particular model. So don't think that just because I'm talking about the daily chart here, that this cannot be utilized on a weekly or monthly basis and allow you to have a long-term position opportunity, okay? And don't think that I'm trying to sell you on day trading because it's going to be a model shown in this, because that's what I illustrate today, okay, for scalping. So the distinction I've made here is when the liquidity pools are equally being purged or engineered, okay, and that means that the timing aspect, or the condition, if you will, is ripe for high probability setups to form. It's not the setup, it's the condition that leads to a future forming setup. Okay, so just know that there's a strong distinction that's being made by me here for that purpose. So the premise is that we would now expect the dollar to rally in London or New York scenario based on this movement into this liquidity pool. I don't know right away if it's going to be the London setup or if it's going to be the New York setup. That's why I have to wait to see what forms. That element of time is going to be a variable for you until you learn more of the algorithmic principles that I'll teach in 2020. Right now, I have to work within the context of you're not going to know, which is a normal process. You're going to grow into your understanding. But if we know that this dollar index is trading down into its liquidity pool, the condition is ripe, okay, or it's high probability conditions for a potential long to form in the dollar. So your focus goes to specifically the kill zones, okay, London Open, New York Open, okay. So now I'm going to drop right on into the pound dollar, because that's where our discussion is going to be remaining most of the discussion here for this teaching. Before I go any further, just know that on Saturday, May 11th, 2019, I gave you the weekly review and commentary for this particular week. I said that we would see a very high probability of the market running down to this level here and hitting the order block, which would be 129.45. It's in the recording. I outline why it's important. Now you see it's traded there today. Okay, so everything that I'm showing you here, obviously you're going to see my executions, the time fills and everything. But I want you to know that this is what the public does not see. They don't see this on Twitter, so my examples are never going to point to these types of things. Okay, so again, don't send me emails and saying, well, why did you take the trade off at this point and not hold it to this level here? Because if I'm going to share my examples on Twitter, like I always do, I don't share them really in the mentorship, because I don't want people that are, on the outside looking at me, wanting to ask me, hey, what trades are you showing or what examples are you showing? They've always been made public on Twitter. No one has to come in the mentorship to see my executions. They're all being made publicly. Okay, so that's why I do that. You're not going to find some secret, you're not going to find some secret results here, okay, and there's something entirely different here versus Twitter. Twitter is where I always show everything. I show my cards on the public because that's where I'm being really weighed in the balances, if you will. So the movement here is what we anticipated relative to the commentary. So you're going to need to go back and watch that video from the Saturday, May 11, 2019 episode to kind of like build on your understanding what led to me anticipating the down move here. Okay, so our premise is we're going to be bearish foreign currency if we get into a liquidity pool on the dollar index below an old low. So sell stops should be allowed to be counterparty to long holders or those individuals that want to buy the dollar. If that occurs at the same time, liquidity is being purged or engineered in euro or cable, then we have a high probability scenario. And it has to be referenced in terms of a kill zone, because then you have the algorithm influence because of time of price and time of day. Those facets of IPTA will kick in and allow the higher probability scenarios to really come to fruition. So what frames the setup? Okay, we have to look for whether the markets are in distribution or are they accumulating. So if we're bearish, we're expecting to see some measure of distribution. We want to see the weaker of the two. So when we look for the weaker of the two, we're going to be contrasting. We already know that the liquidity pool for the dollar index is trading into a sell stop liquidity pool or sell side liquidity pool. So therefore, the likelihood is that it could rally after it trades into that, because it's a large liquidity pool for sellers. So if you're going to be a buyer, you want to be a large pool of sellers to buy from. If that occurs at the same time that either the euro or the British pound fail to make a higher high, the market that fails to make a higher high is the market that's under heavy distribution. So I mentioned this in passing. When we see the SMT divergence between the euro and cable, the market that makes the higher high when dollar is bullish, that market is what you trade on running buy stops. Okay, so that would be a turtle soup sell. The pair that's under heavy distribution that fails to make a higher high, and I'll show you what that looks like here in relative terms to the euro, contrasting the British pound. But the market that makes the lower high, that is the distribution market. In other words, it can't even make the higher high. So it's heavily being distributed or sold off. It's not being allowed to trade higher. Okay, so when we see that, I recently taught you when using the overlays for SMT, the distinction between the two pairs, what type of patterns form relative to the higher high in euro, if that's the market that makes the higher high when dollar is bullish, and what are the scenarios and patterns that form in the pair that makes the lower high. In this case, we would say the British pound, as you'll see in very clear fashion. I'll show you the relationships between the highs and today's price action. I mentioned that fair value gaps will likely form in the pair that makes the lower high. So right away, you already have a huge advantage over those individuals that went through the first group, because they had to wait to the end. Okay, so I'm giving you like a supercharged approach to go into the content you're going through each month, and it's going to help you formulate a better understanding, deeper understanding of price action. But not only are you going to have a better understanding, and you'll be knowing what questions to be answered because of this model, but you'll also, by default, be building a very exceptional trading model that is absolutely strong. It's really, really strong. And it repeats a lot. And it's based on institutional order flow. It's based on IPTA. It's based on high probability scenarios. It's based on all the things that would make a hallmark signature loaded deal. Okay, a lead pipe cinch trade, as Larry Williams would call it. Okay, doesn't mean you're going to never lose. Doesn't mean you're not going to get stopped out. Doesn't mean it's going to be wrong. It's going or never be wrong. It will. Invariably, you're going to be wrong. Okay, I'm just saying that chances are, if you're looking for a home run setup, this is pretty much what you're looking for. Okay, so I kind of like want to just put a little bit of sugar on it, let you know that that's how good this is, in my opinion. So the framework, again, we're looking for the market when the dollar's likely to be bullish. We want to be focusing on the market that's in heavy distribution. That means the pair that makes the lower high. Okay, so if we look at the dollar index making a lower low today in the New York session, which is right in here. Okay, New York session and an overlap into London close. At the same time, the cable was unwilling to make a higher high than it did on Friday. You see that? Here's previous Friday's high and today's high. Now, this is not the intraday high. Okay, this is all being plotted on a closing basis. This whole layout here is explained if you go back through the archives on the weekly reviews. I actually teach you how to do all this. Okay, and I actually provide the indicators that you would see here. Everything is shared. Okay, so don't send me emails, hey, can you tell me how to do this because you're new. It's all in the weekly reviews. Okay, just look for it and it'll explain where it's at. But the euro dollar relative to Friday's high here is higher today. So we had a higher high on euro, a lower high on cable, while the dollar index was making a fresh low. So this is what you would expect. Previous low on Friday and a lower low on Monday. Well, that should be seen with a higher high on euro, respectively. High, higher high. That's symmetrical. This is not symmetrical. This is distribution. This is manipulation. Here's the equal highs they ran. Okay, you all understand that. This is Candyland. This is a run on stops. This is a return to fair value, but it's in heavy distribution. Okay, so we know that this is the market that's under distribution in the New York setup or session. So the kill zone is New York. Market trades up into a SMT divergence, a correlated pair SMT divergence between euro dollar and cable. Okay, so with that, if we look at the opposite, we can see here is cable making that lower high and euro making that higher high, with the dollar index making a lower low respectively. Okay, so I just have that in here so you can see in concert with both views, because you want to have it there, because it just makes it easier for new students that have never really understood or studied SMT divergence. It just makes it easier. Okay, so that's the best thing I can use to describe it. So now we know in New York we have a very strong likelihood because of time and the condition. Remember, the condition was they have to be in opposing liquidity pools. Well, above the equal highs, that's an opposing liquidity pool, right? What's resting below these? Above these highs, buy side liquidity. What's resting above these highs? Here, buy side liquidity. Okay, so both pairs are in counter or opposing liquidity pools relative to the sell side liquidity pool that the dollar's trading into on its daily chart. So we have the condition of the market is likely to be bullish on dollar. The premise is we're going to be bearish the distribution market, which is in this case here cable. Okay, pound dollar's likely to go lower because it can't rally. Otherwise, it would have made a higher high, but it didn't. It doesn't mean that the euro dollar won't decline. It does. It does decline. But look how well it held up in relationship to what we saw in cable. Okay, so again, this is the euro dollar on a 5-minute chart. And then now look at the cable. Much more pronounced in terms of its decline. Okay, so that's the reason why you're going to see me only focusing on the short on cable, not shorting euro dollar today. So right away, I've already taught you how to time based on the high probabilities of a scenario. It's not timing the entry, it's timing the high probability because it's based on the liquidity pool. Then you wait for the scenarios to form inside the kill zone, which is what I just outlined relative to euro dollar and cable. Cable's a weak or the weaker of the two. So therefore, our focus should be on it not selling or buying euro dollar, trading short the cable market or British pound dollar. If we go into an hourly chart, okay, and we go over here and look at this like this, I want to zoom in and ask you, inside of this area right in here, do you see a liquidity pool? Now, your eye would go normally right here, and you would expect that to be ran. And it could have been your initial observation. But once you start entering the kill zone, you see that the cable is unwilling to make a higher high. At the same time, Eurodollar is making a higher high and dollar is making a lower low. We have that sweet spot in market conditions. You have the high probability, you have the time of day, and you have the liquidity factor that is always the signature in high probability setups. And I'll say that again. The run on liquidity or engineering of liquidity is always going to be the signature of high probability setups. The timing is kill zones. It doesn't change. It's always been the same. But what makes the setups that I trade on is the absolute focus of the liquidity. All three have to be in at the same time. They have to be either engineering or purging or running liquidity. Once they do that inside of a kill zone, that's it. You have all the recipes that you need. Then you have to start looking for your pattern. Now, your pattern can be optimal trade entry. It could be turtle soup. It could be a bearish or bullish order block. It could be a fair value gap. It could be a breaker. It could be a mitigation block. It could be a rejection block. It could be a vacuum block. It could be whatever pattern that you like. Trust me, you don't have to have the one that I always talk about. Okay, you don't have to be even a bearish order block. It could be just a fair value gap. It could be a liquidity void. It could be just a standard optimal trade entry. Just a 3/4 pullback in the fib, and that's it. You trade a 62% retracement level, and it's done. That's it. It's over. Nothing else to worry about. You can make this as simple as you want, or you can get as complicated and complex as you want it to be. Doesn't mean it's going to be any better. I just like to know that I can see all of the different avenues with it, and I'll just touch on a few here. But other than that, we want to respect and appreciate the fact that all of you are going to gravitate to a specific PD array. And you'll know what they are when we go into month 5's content. But that PD array is going to be your bread and butter setup. Now, I'm outlining one here. You do not need to use this one, but it's going to help you understand how price action models are built that lead to a trading plan, which again, I will flesh out in my talking. You're not going to get a PDF file. You're not going to get me showing you something on the screen. It all has to come by you writing and taking notes. So we have a distribution market. It's going to be cable. So we're looking to sell short cable. And the time of day is New York. That's when the S&T formed. So if that's the case, what are we looking specifically for? What is the setup? Well, this is the hourly chart when we can see the obvious clear S&T divergence. We're going to drop down into a 15-minute time frame. And I want you to see this high here and these equal highs right in here. You see that? Now, prior to these liquidity pools forming here and here, what was the range? Here to the highs that's being formed. So at this moment right in here, anywhere right in here, the market is extremely overbought. And I don't need to have an indicator to determine that. Inside of this range, right there, this is the low, and this is the high of the current swing. Okay? If we refer to the previous range prior to this one, what would that be? It would be this high to this low. Where are we at here in terms of that? We're in the upper end of that range. So if you ever want to get a measurement without having any indicators, you want to look at two of the most recent dealing ranges. Low to high, we're up in the high end of that new price swing, and this high to this low, we're up here. We're overbought. I don't need to put an indicator on, but I'll show you to you anyway, because I know some of you guys are new and you like to see this stuff. And we'll just do a Williams percent R, and 14% is good. Okay, above the 20, this is all overbought. Overbought. I don't need to see this to be overbought. I know in terms of the range, I'm already overbought because of the the visual interpretation of what's being shown here. So while we understand the market is overbought and we're also inside of an area that creates a high probability scenario, if we go into our chart here, it's a 15-minute time frame. What I've outlined is the buy-side liquidity pool, and then we have a buy-side liquidity pool here, a single high liquidity pool, and this is a multiple high or double high liquidity pool. Either one will operate the same way. It does not matter. I don't look at a single high or a single low and say that's not a good liquidity pool. It doesn't make a difference to me. I know there's going to be liquidity above the old swing highs and below the old swing lows. If there's multiple or equal or pseudo equal highs or equal lows, it's still the same thing. Okay, just your eye will trust the equal highs because you've been taught that in free tutorials for a long time. But you can use the single highs and single lows also for liquidity runs. Okay, so just know that that's not something for you to be getting tripped up and worried about. This rectangle here is just simply just showing the range from this high expanded up. I think the range was 12 pips. Yeah, 12 pips was the actual expansion above this high. If we use simply the 10 pip stop sweep, right there, it takes us right there. It doesn't have to go much more than that to illustrate that 10 pips above this swing high. Beautiful. This is a rejection block, and I'm not going to go into detail about that because you get more information about that in the mentorship, but that's what this is showing here. What was the setup that I actually used? This one right here. Okay, this is exactly what I was looking at. We have relative equal highs, expansion on the upside. If we look at the highs here and draw it up, you can see we had a roughly about 20 pip run above these equal highs right in here. So this is when the setup should form. So if we drop into this area, well, before I do that, if we're looking for a short, okay, what we're looking for is, for this model, we're looking for the SMT divergence to form to find the weaker of the two currencies for correlated pair SMT divergence. In this case, like we talk about all the time, euro and cable. In contrast to the dollar index. Dollar index is making a lower low here. At the same time, cable's being pushed up, but can't make its way above Friday's high, previous week's Friday's high. At that same time, euro dollar is making a higher high here, and that's what we've seen here. We had euro making a higher high relative to Friday to today's intraday high, and then here's that divergence on cable. So again, we're looking for distribution. We have liquidity pools mapped out, 20 pip runs, and then we have a 10 pip run here. Everything is in line with this being a suspect high, so therefore we should start looking for scenarios to sell short on. Now, you can look at this and say to yourself, okay, right away I could be very gung-ho about it and sell right in here and use some stop above here. I don't like to do that. What I like to do is I like to see where my levels are. In this case, we have the bearish order block, last up close candle, wait for the decline, and we'll drop into a 5-minute chart. And that's what this is being shown here. Now, when I showed this chart on Twitter today, guys were like, "Hey, that's not a bearish order block. What are you talking about?" It went right through the order block because they don't know what I'm talking about. But this is the order block on a 15-minute time frame. This in here is the fair value gap. Okay, right in here is the fair value gap. This candle's low. This candle's opening. This candle's high. So we have the gap between this candle's low and this candle's high. One single candle passed through. That's the fair value gap. Price trades up into that level, and that would be your shorting opportunity. Now, you can use the 5-minute bearish order block as an entry, and you would have got that here. This candle's low. 130.34, and this candle trades up into a high of 130.34. But you always want to be building in some measure of a spread, and I'll talk about that in the last couple minutes of this recording. But if we want to drop down into more detail, okay, you can see that single candle right there. When price trades right back up to this candle's high, that's your entry. Your stop would go above this high here. That's it. Real simple. Now, if you're really gung-ho about trying to be precise about it, you want to look to see the actual gap be filled. And you'll see that's where my entry was. And I'm going to drop into a 1-minute chart now. All right, so let me show you. This was today's activity. And I'm going to show you the actual limit order being tagged. All the other ones I'll talk about as we get to the points of importance about it. Right there's my entry. Okay. Now, this is a 1-minute chart. There's literally no drawdown on that entry. Zero. Okay, I'm going to zoom in a little bit more. Right there is my entry. Right there. This candle, note the time of the candle. 1347. Okay, here's the entry here, 1347. There's no drawdown. Even the candle opens here, starts up here first, and then it's coming down. I'm entering it here. Okay, and then it never came back. It just kept on rolling away. Folks, listen. You cannot argue about the matter of precision using this. Okay, you can't. It's impossible for you to argue that this is unbelievably accurate and precise. I'm pointing right here, okay, on Twitter, stating that this last up close candle is the order block. That's just as well. I mean, you could have used that. I mean, I'm not saying I would have, but you can do that, and look at it's given you. Your entry's there, but here's what has to happen. You have to use a stop that has to be behind some measure of a swing high. There's your swing high here that you'd use, okay, on a 1-minute chart. Why? Because your order block is here. You know you could go through it and still be okay because it's a 1-minute chart. The folks on Twitter and the folks in the public are gathered in chat rooms trying to figure out what's going on because they're getting, copies of stuff shared because of their grandmother or their uncle's brother and sister or some goober in the UK that can't do it himself. This right here is enough to warrant the setup. But you have to be able to frame the risk and define the risk properly. So this is the catalyst that gets you in the trade, but that doesn't mean your stop loss is just above that because it's a 1-minute chart. So you have to use market structure to aid you in terms of where your stop loss would be. And it would be right above this swing high here. Okay, very, very ultra tight stop. Now, initially, my stop on the first taking profit, you can see I did not move the stop until I took first profit. So the entry was here, same time. These are all the same thing. I got in the trade and took partials. I took 3 off of the 5 lots that I entered. Right there. 5 lots. I took 3 off when it traded to 130.07. Okay, so at the time, my stop loss was at 130.40 right here. 130.40. Because of that, me taking first profit, then and only then am I allowed to lower my stop. So watch what happens. If I add all of the levels here for my partials, now you have all the points at which where I exited the trades scaling out. Now, when I show a chart like this on Twitter, it doesn't mean anything to anyone on Twitter. They have no idea. They have no frame of reference. It doesn't mean anything. And like one of the guys said, what kind of trade is that? I love that. I absolutely love that because it's right in their face and they can't see it. And that's what I've been doing for all these years in front of all of you. When I was on Twitter and when I was on Baby Pips, okay, when I was doing videos on YouTube, All of those videos were doing these very things, and you still didn't pick up on it. And that was the reason why I was doing that social experiment, because I wanted to see if you all could pick up what I was doing. Now, I already know some of you goobers in here, okay, are going to claim, oh yeah, I figured that out. I've watched the videos and this is what I figured out. But really what you're doing is you're getting leaked content from the mentorship, and I don't want to hear about it, because if you'd figured it out, you would already been making it public to me and you would have been beating your chest about it, okay? It's only because I'm teaching it now. So if we zoom out, okay, here's the entry, and here is all the grouping for me taking profits. You got one here, you got one here, looks like you got one in here, and one in here, okay? If we drop to a 5-minute chart, 15-minute chart, you can clearly see these equal lows here. Equal lows, and you can see all of my exits here were as we were approaching these equal lows and right in there below it. And that's where the take profit was. And that's what this portion of the move is. I gave on Twitter a challenge of 40 pips with a minimum of 15 pips drawdown. I didn't even get 1 pip drawdown. Okay, so the challenge was met, and I do that for homework for you all and for people that are just following on Twitter. I'm not sharing the things I'm outlining here in my example because I'm confident that if I keep showing over and over and over again examples, and that's why people want to see my MyFX book, because if I share a MyFX book and I do the entries and then exits down here, okay, at 129.45, which again, if you go back and watch May 11th, 2019's weekly review and analysis for this week we're trading in now, I actually called 129.45. And we went down to a low of 29.40. Okay, so it's all 5 pips. And I told you, it's about right. Anywhere between 3 and 5 pips is about where my fudge factor is. Okay, how off I am. And that's not bad for working on a daily chart. So looking at this fair value gap in here, okay, it was on a 5-minute basis. The single candle right here, that's your fair value gap. When it trades up into it here, when it did this hit, that's when I was going in, and it happened to fill me right here. And then it never came back. It just kept going lower, lower, lower. I was looking at this low here as the first objective or first scaling on profits. That's what you see here. That's this run below here. That's me exiting on that. I want to take profits, and after I take first profit in this model, in most models, that is the only time I move my stop loss, because I don't want to be worrying about if I'm going to get stopped out. If I put a stop on the original portion of the trade, if I do get stopped out, I've already accepted and allowed for and was comfortable with taking that loss, because it's not going to be over leveraging my account. I'm not trying to make 1,000 pips. It's just I'm trying to get a setup, and then I want to maximize the profit potential, but minimize the risk and define it. So when you get into a trade, if you ever traded with live funds, which is something I tell you not to do while you're in the mentorship, because you need to learn. And if you are trying to do these things, and I'm not trying to teach you a trading model here to go into fleshing out overnight tonight to do the trading plan portion of it and then try to trade it live with live funds, because first of all, you're going to fail. And you're going to be upset, and you're going to blame me, you're going to say it doesn't work or whatever, and because you haven't learned all of the components yet. Again, remember what the context is here. I'm providing the outline for a trading model. You have to fill in the blanks through the 12 months content. Now, some of you, again, are going to hear me say all this stuff, and it's going to go right over your head, and you're going to feel like you really want to send me emails and ask me questions. And I'm already going to tell you, no, I'm not answering them, because it's all explained in the mentorship core content. But the stops do not get moved until we take first profit, because now I have taken something that I've funded the position. I have paid the trader. I've taken a small portion of flesh off the prey. Now, if it wiggles away and gets away, I got something. Now, if I'm in a trade, and you know this if you traded live funds too, or even a demo account, when you put a trade on, you're looking at that stop loss fearful that it's going to get hit. I'm not, because I've already framed the trade with a proper risk model that does not over leverage my account. Even if I get stopped out with a full stop, which rarely ever happens, if that happens though, it's not going to deter me from taking the next setup. It's too minuscule of an amount of money for me to feel the effects of it to change my way of viewing the marketplace. Now, if I can move the stop after I take first profit, I'm removing the risk after I take first profit. That's the protocol. Okay, so when we talk about defining risk on a setup, we're removing the risk and lowering it from the point of our entry to a point where we cannot absorb a loss. Now, theoretically, that's the case, but in reality, the market can gap up above or below our levels, and the stop just doesn't help us there. Okay, so that's always the inherent risk. That's why you trade with that understanding. When you ever decide to trade with live funds, just know that just your stop loss doesn't protect you in that regard, because it can gap up and just blow you right out. And yes, that's happened to me before. Not in a demo, in live funds. So that's the inherent risk. I'll sign that in the disclosures when you open up a broker account. So we've talked about what makes the condition in the marketplace. We talked about the premise, whether it makes are bullish or bearish. We talked about the framework, okay, distribution or accumulation. And when are high probability scenarios forming? When opposing liquidity pools are purged or engineered at the same time with our three markets, dollar and two correlated pairs, which is euro dollar and cable. I get questions all the time. Why am I not talking about other markets? Because you don't need other markets to learn how to do what I do. Now, if I tell you I only focus on these markets, doesn't it make sense for me to only teach from these markets, but also remind you that they're applicable in other asset classes and other pairs? I don't want to dilute my attention span, which is very, very small, mind you. Okay, it's very easy for me to get distracted. In fact, this video is going way longer than I want it to be, but I want to be flexible. I want to be able to say what's on my mind, so that way it doesn't feel stilted. And I also want to have a whole lot of narrative around things, and people are going to get bored. They're not going to be in this video pulling out the nuggets. All by design. So we know what makes a high probability situation or condition for the marketplace, and we know when the timing is going to take place relative to the kill zone. So it's modular. Okay, higher time frame macro view, what's the condition? Then we build a premise, bullish or bearish. The framework is which is distribution or accumulation. Then we look for opposing liquidity pools to form and be purged relative to dollar, euro, and cable. When all three are in their respective liquidity pools, that's when high probability setups form. The timing is the kill zone. When that hits, then you look for the pattern, the optimal trade entry, the turtle soup, the order block, the fair value gap, liquidity void, vacuum block, rejection block. Whatever the PDA you're going to settle on that is going to be yours. There is not one right one. There's no advantage over one over the other. Okay, so don't send me emails asking about that. Whichever one you see clearly, that's the one you focus on. In this case, what I'm showing you is we're using the bearish SMT in the cable. So the SMT is the lower high forming on cable. Then I'm looking at a bearish order block, which is here. Okay. Inside the order block, there's going to be a fair value gap. Right away, that's your answer to your question you've probably been wanting to ask me. Okay, you just signed up. What makes a high probability order block? Which order blocks do I trade? The one that has a fair value gap. I mean, if you don't understand that, trust me, it's answered. Okay, it's answered a lot of places in the mentorship. I'm just not going to say it every single time I do a video. But I just gave you the answer, really, if you understand what I just said. If you don't, trust me, it's in the content you go through on the mentorship. Before you get the charter, too. So you have the bearish SMT, the order block, and then the fair value gap. That's your timing. Okay, your targets are going to be opposing liquidity pools. That's this low here. That's this low here. You see all my exits? My exit here, below the low. That's liquidity. So I sold here near the high end of the range. Did I need to get the highest point of the move? No. because I already know the mechanics. And those of you that have been with me prior to May starting know that I lace the weekly reviews with all kinds of information. That's where your learning is going to be. Those top of the page lessons, just trust me, okay? That's not it. They're just things to help frame each month's learning. But I'm teaching always, continuously. I have so much stuff that you can't get all of it just in a couple teachings per month. It's going to have to be several times, a week, which is what we have our weekly review and our midweek review. And I use the examples to kind of flesh out what it is I've done and draw the context to what it is you saw in your lessons. I'm selling near the high when it's still overbought relative to this range here to here, or this high here to this low here, or this low to this high. I'm selling way up here. So the market is what we refer to as a premium market. It's overbought. The public's going to be chasing things like bull flags in here. They're going to be looking for, continuation patterns, all kinds of stupid stuff that aren't going to make any sense whatsoever from an institutional side. I'm looking for a market that has already shown a willingness to want to go lower. How am I looking for that? The market's traded up into a level, which in this case, I was trading the rejection block, and you'll learn what that is. I want to see the market show its hand to me. In other words, I want to see a willingness to drop down. It does so here. When it does, it leaves a small little pocket of inefficiency, which is the fair value gap. Once I see that, I already know what I'm doing. I'm done. I already know that's my pattern. That's what I'm looking for. Because it's the weaker of the two pairs, then the pattern that usually forms in IPTA is there's going to be a fair value gap in the sick sister. In other words, the one that makes the distribution pattern relative to SMT. You wait for the fair value gap to fill. Once it trades to it, that's it. It's a lock. You just go in, you enter, put your stop above the recent swing high, walk away. You don't do anything until your alerts on your phone or your computer or whatever tells you start getting in close proximity to this low. When it does, you have your order already set up on your screen to take or modify is what you're doing. You're modifying an existing order. So you click on the order, click on modify, then you change it to execute or immediate execution. And then you're going to take a portion of that trade off. For me, I wanted to take 3 lots off of the 5 I instituted from the beginning here. And that's what's been taken off here. Right there. Okay, so 3 comes off there below that low. So I'm selling it up here when everybody else wants to buy it because it's being chased. This is all Judas swing inside of the New York kill zone. So I'm selling it up here when it's high at a premium at a logical level where the institutions will want to go in because IPTA is allowing that to happen. Okay. Once this occurs, you want to be in. It's not going to give you a lot of time because this is a 5-minute chart. Now, it does not mean that you can't use this on an hourly chart or a 4-hour chart or a daily chart. I already showed examples where you can do the same setup and entry technique on a daily. And it can be done on a weekly chart too if you want to be a long-term position trader and you don't have time to be worried about nickel and dime in your entries. It's better for you to know these things because you can refine your risk and make it smaller and have a larger multiple in terms of your risk to reward gearing. But you don't need to have high position when you're doing long-term position style trading. But in intraday trading, scalping, and day trading, you absolutely need it, okay? Because you can get really hurt if you don't. So with this fair value gap being filled and the order block, that's this model. The target or terminus is going to be what we use on the higher time frame. That was on the Saturday review and commentary for this week's trading. So before the fact, I told you that we would see 129.45 likely as a downside objective. That's the long-term terminus. Okay, so if you're a one-shot, one-kill trader, that's what you reach for. When I give you these objectives or levels on the weekly review, that's what I'm kind of pointing to for the weekly range. So you want to be focusing on that. It does not mean they won't be breached or doesn't mean they won't be surpassed, or sometimes they won't even be hit. But it's the general direction we want to be trading in because of the likely expansion for that weekly range to move either higher up or lower down. Okay, so All I'm trying to do is predict that weekly range is going to be having a more high probable scenario for it to expand on the upside or on the downside. And because it's the weekly range, I'm only looking for 50 to 75 pips for a one-shot, one kill. This particular day here, if we look at that and zoom out, here's our, what is this level here? There's 129.46. And that's really just this. I'm going to show you what that means here. If you look at the 15-minute time frame, it'll be clear to you. We have an old low here on the 9th. This low is 129.66 in 5 pipettes. Forget the pipettes. If your broker doesn't show that, it doesn't matter. We're looking at the whole numbers here. So 129.66. A sweep on that low of 10 or 20 pips, in this case, at 20 pips below that, would be taking us down to 129.46 in 5 pipettes. That's right here. Beautiful. Look how much, it just goes right into that. Okay, we get 2 wicks there, but the bodies stay around that, and then we expand up. We're in a really sweet spot when we start combining higher time frame analysis with our intraday trading, because you won't be taking these little small pieces, okay, and even this one down here below the equal lows. This exit here at the target as it hits, that's this one here. That's all I wanted to show for the weekly challenge for Twitter. I already told you on Saturday, on the 11th, that we would likely see 129.45. We hit it beautifully. So if you are a one-shot, one-trade, I'm sorry, tongue twister. If you're a one-shot, one-kill trader in the making, or if that's what you want to try to do, you use the analysis points that I give you on the weekly review. The day trades or scalps, you're just going to look for intraday liquidity pools to offset at. Okay, they will represent your terminus. As a swing trader, okay, entering up here, what is the parent price swing for this high here? This swing low. So if you look at this high to this swing low, measure that and project it down, that'll give you your objective down here as well. So that's your way of using it for swing trading. That means if that's your model, you're going to take your first profit once you sell short up here. You want to take first profit below this fulcrum point, right below this swing low, because it could come down there, run through it, and then go higher. So that would be your first profit. As a scalper, your first profit is here, and then take something off here, and then do projections 10, 20, 30 pips below here, and then or use this one over here, which is beautiful confluence of factors, because we mentioned to 129.45 last Saturday, and then we hit it today. So only off by 1.5 pips relative to what I said on the 11th. But you can see how we start to mesh all these different concepts together, and you can see there's hallmarks and signatures of the algorithm all the time. It's repeating all the time. But if you're a swing trader and you're not scalping and you're day trading, you're selling up here and you're taking first profit down here. That would be your first profit, and then and only then do you move your stop. Then you look for your symmetrical price swing, which would be this move high to low and down. And the way that would look like is this. Here's your swing high, and you swing low, high to low, symmetrical price swings right here. So you're getting out right there. But notice that this level here is just short or above, in this case, our 129.45 level that I mentioned on the weekly review. So we're looking at a target of 129.54. That would be reasonable to expect that, but we also know that there could be an expansion down into that 129.45 relative to the commentary that I gave you on May 11th review. Okay, so all of those things, really nice confluences there. The bodies of the candle respecting that level we talked about. So it's just really nice. So, defining the risk. The setup timing, okay, where you time the entry, you're going to use the swing high when you're bearish above your entry point or your fair value gap, okay? If you're bullish, everything that's being shown here or talked about is going to be reversed. You would be using the swing low. Your stop would be below the swing low. That would be below the fair value gap. Okay, so everything I said, and trust me, I know I talked a lot. I know I said a lot, okay, but you need to listen to the video and write down the things that I just gave you, because I gave you all the things that you will learn in an outline form for one shot, one kill. I gave you day trading. I gave you scalping. And I also talked about how you can apply this to a daily chart and weekly chart for position trading. So even though we're looking at this in respect to intraday in a 15-minute time frame, and that fair value gap that's being shown on a 5-minute chart, that is absolutely applicable to a weekly, daily, and 4-hour, using the 4-hour for fair value gap entry for a swing trade, or using a monthly and weekly, and then a daily fair value gap for a long-term position trade. So there's absolutely no reason why you can't find what you're looking for just in this presentation here. The outline or framework for just this one particular model is scalable in all of those disciplines, but you don't need 20 more different price action models. One of them is going to resonate with you. This one may not. Some of you may say, well, this has really helped me figure out a lot. And then you're going to glean more information from the future lessons in the mentorship. And then when you get into charter members and you start looking at all the other price action models, it will complement this one. And it'll help you with your overall understanding of price action. And you won't be rushing. You won't feel this insatiable desire to rush doing something. I need to be doing something. You don't even know what you're supposed to be doing. So now you know what it is that you should be looking for. If there is no setup based on this, you don't do anything. Now think about what I just gave you. I told you a complete outline for when to get in, when the setup should form, when is it high probability, what does the setup look like. I traded the setup. Okay, I gave you everything here. I told you what I used, and it's also building on the things that people have already gone through the mentorship. No, everything I just said here are exactly verbatim the rules. I've not twisted anything. I've not made it form-fitted. It's exactly how I taught it, and I executed on it. And I gave the people in the public what they were looking for, the 40 pip exercise, and you're seeing how the scale for scalping, day trading. I've shown you here with May 11th's target. It went down and hit that as well. Just know that every question you have right now, if you have any, you will find those answers in the core content lessons going forward, or I may drop them in a weekly review. It may come out in my commentary. So just be mindful that when I'm talking, you want to be listening, because you don't know when I'm going to drop something, and I don't have a script. Like, I have bullet points in front of me, but like I did with this video, whatever comes to mind because of experience. And I'm also trying to use my a certain measure of discernment, knowing what you're going to have in mind as a question, because I already know, based on what I'm saying, what will spur in terms of uncertainty or doubt or confusion. I already know what those questions are going to be, okay? And I already answered them in future content. It sounds like I'm kicking the can down the road. I had a lot of people complain in the first group, oh, you're never going to get to it. I got to it, okay? Now the people that went through the first group, the first charter members, they're just now getting a lot of the things I've already said in the first time. It's so much content, and it's so much more that we have to go into, but I don't want to leave the people behind, and I don't want you to be discouraged, because some people come in here 1 or 2 months, and because it's not a signal service, they're just, I'm not interested in this. He's not spoon feeding me, so I'm going to leave. I want you to understand that what you're learning how to do is you can create your own signal service. Once you learn how to do this, you want fast money, easy money, know how to trade really well. Okay, start up a room, and then tell them what the market's going to do. Now, don't teach what I'm teaching you here, because once you teach it, then they ain't going to stay with you. They're just going to leave. You give them setups that form over and over and over again that are highly precise. Man, you have a lifetime of income, a very affluent lifestyle, easily accomplished by simply putting the work in, learning how to trade, and then you can operate your own signal service. Now, you may not want to do that. Maybe you want to do analysis, where you talk about the likely scenarios of this or that. But again, not teaching my concepts, okay? You don't want to teach like I'm teaching. You're paying to learn how to do this. Some of you already have in your head that you're going to go and just copycat me, like people on Facebook, they're out there trying to talk about how they understand IPTA. They don't understand anything. All they hear is, or what they hear me saying about IPTA, because apart from me, no one else is talking about it. And they don't understand ICT because I haven't taught everything yet. You only know little pieces of it. But if you want to do analysis or if you want to do signal services, in this mentorship, I give you specific boundaries with regard to how you stay in good relationship with me. Because if you don't stay in good relationship, I throw you out the door, okay? And I'll publicly scorn you. And depending upon what you're doing, and I'll go after you legally. So I don't want that. You don't want that. I want you to be successful. And I want you to use this information to do very, very well. But if you don't put the work in and really put your, efforts into trying to make it understandable for you, because I have lots of models. I'm not limited to 12 models. I have a limitless supply of framing setups because I understand what specific macros the algorithm will do at certain times of the day, certain days of the week, certain months of the year. I have all that stuff, okay? But I'm not throwing it out there for just anybody. The folks are going to have to go through a lot of content to get to those higher level principles. Do you need those higher level principles? Absolutely not. I've shown you here today. In the free tutorials, I've shown you enough to be profitable there. But you're here because you want to learn everything. And that's why it's a lifetime membership. You got 27 years of experience to mine from me. And I just cannot put it all out in a couple videos, each week. I can't do it if I did it daily. But I can give you a long-term relationship, a friendship, a community where you can always tap into and get more understanding and refine your model based on the things that I have already suffered. And I don't want you to go through those types of things. So if you take this information, make it your own, make it relatable to you and your personality. Don't let me ever in the mentorship try to convince you or coerce you into a specific approach. I've given you the rules here to make this any model you want it to be, whether it be position, swing, short term, one shot, one kill, day trade, or scalping. It does not matter. It's all 100% scalable. The specifics about how you scale it are given in the later portions of the mentorship, where I actually specifically talk about position trading, swing trading, short-term trading, day trading, and scalping. All those things, the actual breakdown of what time frames you use and all that stuff to make it work, if you take that and you blend it with what I've shown you in this teaching here, you can build your own model and you'll know exactly what you're doing. Every single time you sit in front of the charts, you know what you're looking for. If it doesn't form, you're not doing anything. You're waiting for more information. It's simple. It's simple, but it's hard getting to that point where you trust the proven model. So hopefully you've learned something here. I think I've covered all of my bullet points, and that's going to be it for this one. Just know that everything here, it's executed. You see the time and date stamps. Everything is here. Nothing is photoshopped. I mean, it's all based on the things you see me talk about. And this is just one day's worth of trading. But it's based on the things I talked about in lessons, future lessons you're going to see if you're new, and the analysis I gave you on Saturday. So I'll talk to you next time. Wish you good luck, good trading.